Hi, I'm Christine Benz for Morningstar.com. Is your emerging markets fund gorging on China? Joining me to discuss that topic is Dan Satiroff. He's an analyst in Morningstar's Manager Research Group. Dan, thank you so much for being here.
Hi, Christine. Thanks for having me.
There's been a lot written about this issue of concentration in Chinese securities in emerging markets portfolios. And we're going to talk about that and talk about some funds that have workarounds or have portfolios that aren't as heavily skewed toward China. But before we get into that, let's talk about total market international funds. How heavily exposed are they to a single region, China?
So this is really kind of an important point to stress. If you look at sort of a total foreign market fund, emerging markets make up about 15 to 20% of that universe. So they're a relatively small portion of the total international space, and China in particular makes up maybe about 7%, 8% of that mix. So it's not really a huge problem if you're already in a total international fund, or if you have a portfolio, let's say, where you have a developed markets fund and an emerging markets fund. So this problem of country concentration is really, really focused on just the emerging markets universe.
Okay, so let's look specifically at broad emerging markets ETFs that simply weight markets by market capitalization. First, let's talk about why they are so heavily exposed to China, and then let's talk about what their concentrations look like.
Sure. So if you look at what's really happened over the past decade, the Chinese stock market has been one of the stronger performing ones in the emerging markets universe. So that's one of the reasons why China is so heavily weighted in a lot of these. The other reason, I think it's smaller, but it's still important, is you've had the introduction of A-shares. FTSE did it a few years ago, and now MSCI has brought them on this year.
So these are Chinese A-shares?
Right, the locally listed A-shares. So those two factors have really been driving this larger allocation to China in a lot of these funds. And right now, depending on the index you're tracking, it's anywhere between about 30 to 35%. The MSCI indexes are around 30, 31, and the FTSE indexes are around 35. So either way you look at it, it's a pretty big chunk of the emerging markets universe. I think most people would agree.
Right. So if you're buying one of these broad total emerging markets products, you better like China because you're getting a lot of it.
And we've seen this problem before in other international indexes. If you look at the IFA index going back to the early 90s, it was heavy in Japan.
Right.
And that's kind of weighed on it over the past few decades. So it's not as bad as that situation, but it certainly is kind of a cause for concern.
Okay. So you and the team who focus on passive strategies, you have looked at some of the emerging markets products that for various reasons have less exposure to China. So let's talk about that. These are so-called strategic beta or factor emerging markets funds. How do they arrive at less exposure to China?
So some of them are kind of coincidental, but some of them are controlled. So for starters, we'll look at the Schwab Fundamental Emerging Markets ETF. Really what that is, that's a fundamentally weighted index of large companies listed in emerging markets. So being that it's a fundamental index, this is really more of a value fund.
Okay.
That has about 20% exposure to China. So while that's favorable, the one thing I would point out is this is a value fund. You're taking on other forms of risk within that fund. So you have a higher exposure to commodities-based companies, primarily oil and energy companies, and then a little bit more in the materials sector as well. So while it's good that you're dialing back on China, you're taking on some other risks there as well.
Makes you more economically sensitive, one would think.
Exactly. They're much more sensitive companies to the commodity cycle. So we have that fund at neutral right now for that type of reason. Another fund I'd point out that I think we're much more favorable of is the iShares Edge Min-Vol Emerging Markets ETF.
So that's a low volatility product.
Correct.
Okay.
So what that fund is really doing is it's looking for less sensitive companies. So you're a little overweight in the consumer staples and the utility sectors, as you would expect. And that fund, at the end of the day, washes out. You're about 25% in China with that fund. So a little bit better compared to like a cap-weighted index. But the bigger thing is you're taking on a lot less market risk with that as well. So we've got that at silver for that reason. And the expense ratio is also pretty good at 25 basis points.
Okay, so the value to this fund is not just that it has controlled exposure to China, but it also reduces risk overall.
We
in the
think it's going to
portfolio.
be more stable going forward,
Okay.
and so far its track record has shown an ability to do that. So
Okay.
we're pretty positive on that.
So it might be a little easier to own. DFA also has a product that has reined in its China exposure. Let's talk about how Dimensional approaches constructing its
Sure.
emerging markets
So
product.
they're a contrast compared to the other two, whereas the weights in China of the previous two funds were kind of coincidental. Those funds don't really control their exposure to China. DFA goes a different route and directly controls its country exposure. So right now, China's about 17.5% of the fund, that's what DFA targets explicitly. So that's not just for China, that's for any country. So it's at 17.5% right now. But the other big benefit with a DFA fund like that is it's just super diversified. Thousands of different stocks, it generally represents the universe very well. You don't see any sector or industry biases like we saw in the other two. So.
Okay, so this one is silver rated too. I guess one caveat though with DFA is I can't just call up DFA
Right,
and say
and
I want to buy this fund. You need to work through an advisor who
Correct.
uses DFA.
That's the big problem with this one is it's such a good fund, but you really got to be working with an advisor or an approved intermediary to get access to it. Some 401k plans might have it, so it's something to watch out for. But yeah, that's always the sticking point with DFA strategies.
Okay, Dan, really interesting topic. Thank you so much for being here to discuss it with us.
Oh, you're welcome. Thank you.
Thanks for watching. I'm Christine Benz for Morningstar.com.